The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, good evening, everyone. Welcome to today's webinar session. Today with us are Rajesh Verma and Anshika Prajapati. Rajesh is the Deputy Director of Tanker Shipping Research Team, and Anshika is his Senior Analyst. Before taking start of the webinar, I would like to introduce Drewry and what we do recently. As most of you might know, Drewry has been in the market for more than 50 years. We are a leading national provider of research and consulting service. So research plus advisory work are supporting and compensating each other. We have four main business units: maritime research, maritime financial research, maritime advisory, as well as supply chain advisory. Besides research team publishing a wide range of market reports, our advisory team provides extensive bespoke service in the maritime universe to our clients. And naturally, chemical and product tanker are one of the key sectors within it. So in the chemical tanker sector, not only we have extensive research as a base, plus we have a range of internal database to meet the analysis requirements. Our advisory experience covers all aspects of chemical tanker sector, from freight benchmark, freight market outlook, to strategic plannings. Lastly, we have a strong track record in the due diligence exercises as well. So I would like to share with you a case study we have done recently, a project mainly doing analysis on vessel size developments for various sectors. The client has a port handling facility for MCH and Tuluin. We have helped them to develop traffic analysis and forecasted the trend of chemical tanker size in the medium to long run. So we have seen the greenfield related inquiries has growing fast in the recent years. So with no more further introduction, allow me to pass the floor to Rajesh Verma. Rajesh, over to you.
Thank you, Serena. Hello, everyone. Welcome to this edition of Drewry webinar. So in this webinar, we'll basically discuss about the current status of chemical tanker market rather, and outlook for 25 and 26. The current chemical tanker market is at very interesting juncture. Over the last 2 years, in 23-24, freight rates were very high, and that was mainly supported by some shift in trade patterns and stretched voyages. The disruption to Suez Canal traffic, especially in 2024, resulted in the tight supply in the market, and which in turn kept the freight rates high. However, in 2025, we have seen a significant softening in freight rates. And one of the main reasons behind this current softening in freight rates is a brisk expansion in tonnage capacity in the market. So with strong deliveries this year, tonnage supply has improved, which in turn has resulted in some easing in the tonnage supply in the market, despite the disruption to Suez Canal continues. Now, Apart from the supply side dynamics, the current demand outlook or current demand pattern is also not very bright at the moment. Global trade of chemicals, it has been affected because of the ongoing trade war, uncertainty over US tariffs, and at the same time there has been some capacity expansion in the importing countries side, which in turn has resulted in a slow growth in global chemical trade this year. So with the combination of the influx of fresh tonnage, at the same time sluggish growth in demand, it has resulted in softening in freight rates. And if this softening in freight rates is finally getting reflected in the asset market side also. So asset prices have finally started showing some signs of easing. So as we expect like the tonnage supply growth to remain robust over the next couple of years, and at the same time demand growth will be muted, we expect freight rates to remain low in 25-26, and at the same time this asset prices will also follow the same. On the supply side, there has been a surge in tonnage ordering during 23-24, and that has resulted in a surge in overall order book. Chemical tanker order book at the moment is around 80%, 18% of the fleet, and which we believe like will result in a surge in deliveries over the next couple of years. So including 25, 26, 27, we will see a strong deliveries in chemical tanker market, which in turn will inflate the tonnage supply. So new orders surged over the last two years because of high pent-up demand. So if you see the bottom right side chart, here we can see that the delivery schedule for the next 2 years is very strong. At the same time, like the 23-24 orders were strong mainly on account of pent-up demand. During 2020 to 2022, orderings were low because of limited yard capacity, and owners were waiting for their slots. And once they got the slot, they increased ordering in the chemical tanker market. Additionally, the strong freight rates in the market also resulted in strong ordering during this period. Nonetheless, we can see a sharp decline in tonnage ordering in 2026. Now, one of the main reasons behind this tonnage ordering is the order book is already inflated. It's about 18% of the overall fleet, which will result in strong deliveries over the next couple of years. Additionally, the ongoing uncertainty over the IMO regulations, that is also affecting the chemical ordering in the chemical tanker market. The global carbon tax by IMO, it will be implemented, it will come into force in 2027, but still there is a huge lack of clarity in this area. People are not very clear about the future suitable fuel type. At the same time, the penalties for the emissions, or you can say pricing of emission, that is not clear at the moment. So ship owners, because the order book is already healthy, they can wait for some clarity on this front, and after 26 we expect like tonnage ordering will gather some momentum. But in between these 2 years, we expect ordering to remain muted, and which bodes well for the long-term prospect of the chemical tanker market, as after 2027 maybe there'll be a significant drop in deliveries, which will help the market in rebalancing, as we expect like demand or global chemical trade will continue to grow. So these two will rebalance after 2027. We expect like chemical tanker fleet to increase by 4 to 5% over 25-26, and that, as I discussed earlier, will be primarily because of strong order book at the moment. In the meantime, we expect demolitions to remain subdued, especially in 2025, although freight rates have declined from 2024 levels, but they are still attractive, and owners are reluctant to scrap their tonnage at the moment. Additionally, there is no real pressure of IMO compliance, so there is no specific like penalty at the moment. So owners are like currently continue to operate their old tonnage. Nonetheless, we expect like demolitions to inch higher in 2026 as regulatory pressure increases. In 2027, once this global carbon tax come into force, we expect the tonnage scrapping to surge. So before that, there'll be sluggish or subdued scrapping activity, which in combination with strong deliveries will result in a surge in global chemical tanker fleet in 2025 and 2026. In terms of demand side of the story is not very bright for the chemical tanker market. Over the last 2-3 years, the demand growth, trade growth has been subdued, and one of the main culprit behind this was organic chemicals. There has been like in the recent years, last 3-4 years, there has been a significant surge in production capacity in China, which used to be a major importer of organic chemicals, and that has resulted in oversupply in the organic chemical market, and which has resulted in a slow growth in organic chemical trade, primarily led by growing methanol trade. However, inorganic trade, it will remain strong after strong 2024. We believe that inorganic chemical trade will increase by about 3% in 2025, and which will be primarily led by strong growth in caustic soda trade. Additionally, veg oil trade, which has been hampered in the recent years because of growing biodiesel mandate in Indonesia, that is likely to inch higher this year. One of the main reasons behind this is strong growth in soybean oil trade, whereas palm oil trade, which has declined in the recent years, will remain stable. On the miscellaneous commodities, which includes UCO, biodiesel, lubricating oil, we expect the trade to remain weak this year. And one of the main reasons behind this will be weakness in UCO and biodiesel trade. Biodiesel trade, because of all these tariffs or sanctions on Chinese biodiesel by Europe, that has resulted in subdued trade this year. At the same time, UCO is struggling. Earlier, like the Chinese export to US, it increased, but with the increase in tariff, US tariff on Chinese goods, this year the trade is sluggish. So we expect all in all miscellaneous commodities trade to decline by 1% this year. All in all, like overall, we expect the global chemical trade to remain stable this year before slightly inching higher in 2026. If we talk about the organic chemical side of story, as I said, the market is struggling with a overcapacity because of strong growth in capacity in China, which was earlier used to be a major importer of organic chemicals. So all major markets like paraxylene, styrene, ethylene, glycol, all these markets, there have been a massive capacity addition in China, which in turn has resulted in a sharp decline in Chinese import. Traditional suppliers of Chinese buyers, they have like looking for the alternative market, which is like they have limited options. So because of this overcapacity, margins are low in the market at the same, which in turn is hurting the operating rates. So at some point of time, like because of this overcapacity overhang will take at least a couple of years more to rebalance. There'll be, we expect some capacity rationalization. Plants in Europe particularly, and to some extent old plants in China, they are closing operations. So with the help of like closing like capacity closures and some gradual increase in demand, we expect the market will rebalance in the coming years. But at least for 25-26, we expect there is not much scope for increase in these chemicals trade. Nonetheless, like methanol will be one bright spot, and which in turn will keep the trades growing at a sluggish pace. For example, if we talk about the capacity expansion in China and its impact, the two lower bottom charts shows that China's styrene monomer capacity, it doubled from 2019 levels in 2024. So with this huge capacity expansion, the Chinese imports, they have declined like anything. And after this massive decline, interestingly, this year we expect China to be a net exporter, although it will remain a net exporter briefly. But considering the huge trade or huge import by China in 2029, now it has turned into net exporter. This itself explains like the massive capacity expansion in China. So all in all, the organic chemical trade will take a couple of years to recover from this global glut in supply or overcapacity. Now I'll hand over the floor to Anshika. She will explain about the inorganic chemical market and developments in the vegetable oil market. Over to you, Anshika.
Thank you, Rajesh. So, yes, without further delay, let's talk about inorganics trade. So, we expect inorganics trade to grow by 3% this year, which is the highest among all the chemical segment we have talked about so far. And talking about the previous year, again, inorganics trade grew by 4%, which is the highest among all the segments. What is common in both years' inorganics trade growth story is the robust demand and trade for caustic soda. Not just caustic soda, sulfuric acid and phosphoric acid also grew, but they grew at a very modest rate. This is because of rising domestic capacity expansion in major import countries. For example, Morocco and India, they are rising its capacity of sulfuric acid and phosphoric acid, which will weigh heavily on its trade. On the other side, caustic soda demand outlook is very strong, as the rising alumina refining and rising paper and pulp industry packaging sector during this e-commerce era, and rising water treatment plants, all these factors will support caustic soda trade. If we look at the caustic soda exporter side, then interestingly we see that the China's share in total caustic soda trade has grew massively over the years. So in 2019, China's share in total caustic soda exports was only 4%, and it grew to 16% in 2024. And this year we expect it to rise by 2%. This is because China has increased its capacity massively in last 2 years, and thus we expect China to remain a dominant player in caustic soda exports. Okay. Yeah, so moving on to vegetable oil trade. This year, we expect a stable growth in vegetable oil trade as Indonesia has increased biodiesel mandate and only a slight recovery in palm oil. And thus vegetable oil trade will be affected. However, last year, vegetable oil trade dropped slightly, mainly because of reducing palm oil volume. Again, this is because of Indonesia's reduction in palm oil exports, as it has increased its biodiesel mandate. As Indonesia contributes to around 60% of total palm oil exports, any regulatory change in Indonesia impacts palm oil trade. However, in 2025, rising soybean oil trade, as we expect a strong growth in Argentina and Brazil soybean oil production, it will support the vegetable oil trade. However, for 2026, we expect vegetable oil trade to decline as Indonesia has increased its biodiesel mandate by 10%, which will weigh it on its palm oil exports. If we see in the bottom chart, the relationship between Indonesia palm oil export and the biodiesel mandate, we see that its exports are declining continuously as it is increasing. It is continue to increase its blending mandates, which will impact the vegetable oil trade. So just to summarize our today's discussion, we expect the seaborne trade of chemical to remain stable in 2025. And we expect only a slight uptick in next year, which will be supported by a robust inorganic trade. On the supply side, because of strong order book for last 2 years, we expect deliveries to surge and which will increase the fleet growth. Thus, we expect the tonnage supply to outpace the tonnage demand, which will weaken the rates this year and in 2026. However, on the downside, any improvement in Suez Canal traffic will weigh heavily on tonnage demand, in ton-mile demand, and it will lead to a drop in rates. On the other hand, any increase in scrapping because of increase in IMO regulation and the penalties will lead to limit the fleet growth, and it will help limit the declining rates. Yeah, so that's all from our side. Thank you. If you have any questions, so we are here to answer.
Okay, thanks, Anshika. Thanks, Rajesh, for your presentation. That's really helpful. I have a question here. So, do you think there will be slowdown in vessel speeds in chemical tanker markets? Will it change your outlook?
In the recent years, like after the implementation of IMO regulations, like the speed has already gone down. Nonetheless, like because of this stretched voyages, because of Suez Canal traffic, there has been a slight uptick in speed in 2024. But we believe that because of regulation, obviously, to comply with the regulation to limit emissions, there'll be some slackening in vessel speed going forward, especially in 2026, and that will, like in terms of like overall supply growth, that will limit the growth. But nonetheless, we expect like the supply growth will still outpace the demand. So the market will remain, like freight market particularly, will remain weak in 2025-26. Yeah, Sarna, hope that answers your question.
Okay, and another one, if the current U.S. tariffs on Chinese goods remains stable after 90 days cooling periods, what will be the impact on the chemical tanker markets?
So if we talk about the direct impact of this on the chemical trade, it will be very limited. The bilateral trade between these two countries is barely 1% of global trade. So mainly on the export side, China exports UCO to US. On the other hand, US exports ethylene glycol to China. So this trade will be affected. The UCO trade is already has started to get affected because of the tariffs. At the same time, for ethylene glycol, China has enough the alternative markets like Middle Eastern producers. They can increase imports. So there will be some change in trade pattern because of this, but majority of the impact will be indirect. If these tariffs remain and it affects the overall finished good trade of China with US, in that case, it will impact the operating rates of major chemical, organic and inorganic, especially organic chemical verticals, and which in turn will curb the overall exports or overall trade in the major bulk chemicals. Yeah, Serena.
Okay. And the trade pattern change. So basically, for example, if the market shifted to Middle East, then the ton-mile demand would be reduced in that case.
Yeah, that will be negative for the ton-mile demand. But as I said earlier, the overall trade between these two countries, it's barely 1% of global trade. So in terms of the overall chemical tanker market, that impact will be limited.
Okay, thanks for the clarification. Okay, just we have one more question comes in. You mentioned in the end of the Red Sea crisis, but surely this is far from over. So this should support rates. Is that correct?
Yeah. So in our forecast, we have assumed that because there is no clear signs of any improvement, we have assumed that this crisis will persist over the next 4 or 5 years. Maybe like that is a downside risk itself, because whenever there's any improvement in traffic, it will be negative for the market. But for the moment, we assume that this will continue, and because this a sudden increase in tonnage influx, that will inflate the tonnage supply. So despite the Red Sea crisis continuing, rates will soften in 25-26, primarily because of a slow growth in demand and huge influx of fresh tonnage. Yeah.
Okay, so basically, even the Red Sea crisis persisted because of the flooded new build markets, new build vessels coming into the fleets, the rates would become softer in next couple of years. Okay, that's clear. I think we have covered all of the questions in our question panel. Thank you so much, Rajesh and Anshika, for your presentation, and thanks everyone for joining us today. I hope you find our presentation useful. Have a nice day, everyone.
Thank you.
Thank you, everyone.